Hello, everyone. My name is Maricela Gomez. I serve as a finance and loan analyst with the Lender and Partner Activities Branch. Welcome to today's live training on USDA income and assets. Today's topics are covered in our Handbook 1, 3555, chapters 9 and 5. We'll be reviewing the agency's eligibility income limits, annual income, which will also include adjusted annual income, repayment income, and income verification requirements. We'll also look at assets, and we will end with some important and helpful links and websites that are available to our lending partners. We'll begin with a brief overview of the eligibility income limits. For more details, you can refer to Handbook 1, 3555, Chapter 9.2. The eligibility website is a tool that helps you determine if your applicant qualifies based on their income. There are a couple of different program tabs at the top, so make sure you select the Single Family Housing Guaranteed, as our income limits are different from the direct program. You have two options. You can click on the income eligibility button, and the program will assist you in calculating both the annual and adjusted annual income to see if they qualify, or you can choose the income limits button, which will bring up a PDF file. We recommend that you bookmark it to quickly access the website, and for your convenience, the direct link is at the top of the slide. The income limit charts are typically revised each year in July, so we anticipate the release in the upcoming months. This is the PDF file that I mentioned. It displays a map of the US that will allow you to click on the state that the property is located in. The sample I pulled is for Pennsylvania. Scroll to the appropriate county and look for the number of people in the household, and then look for the moderate income guaranteed loan income section. If the applicant's annual income is higher than that amount, then they may be over the income limit, as we haven't looked at deductions yet. The adjusted annual income is what you want to use to determine program eligibility. This is a good reference to have on hand as you help pre-qualify your applicants. Some counties are contained in a metropolitan statistical area, or MSA, which is a specific region consisting of one or several counties that includes a major city and its surrounding communities. Because MSAs often have higher living expenses, our agency sets different income limits for these regions. So this means that a household may qualify for our programs at a higher income level in an MSA than in other rural counties, if the area is eligible for the program. And you can find a list of these counties by clicking the link above the US map. Now that we've covered the income limits, let's review the annual income. Detailed information on this topic can be found in Handbook 1, 3555, Chapter 9.3. There are three categories of income and two methods for calculating it. One method determines program eligibility using annual and adjusted annual income, while the other evaluates whether a borrower qualifies for a purchase based on repayment income. For categories of income, we have the annual income, which is the gross income of every adult household member who will be occupying the property for all or part of the next 12 months. The adjusted annual income is the final income after you apply the allowable deductions that are relevant to your loan application, but you're not required to use deductions. The adjusted annual income is the amount that you will be used to determine program eligibility. So make sure you look for all possible deductions to help reduce the income if your applicant is over the income limit. And then finally, we have the repayment income, which determines if the applicants have sufficient income to repay the mortgage in addition to recurring debts. For this income, we only consider the stable and dependable income of those who are parties to the note. As you know, there are several different types of income that can be earned, include the total gross income from all sources that will be received over the next 12 months by all adult household members. If any adult members earns or have earned overtime, bonus, tips, or commissions, these amounts must be reported unless you can provide documentation proving that they will not continue. For the history of each income type, we will be looking at the attachment 9A. Let's begin with what's included in the annual income. Again, this refers to the gross income from all adult household members who will be residing in the property. It includes any benefits that are received on behalf of minors. For any adult full-time students who are not party to the note or spouse of the applicant, you will only count the first 480 of earned income. With regards to assets, include income from cumulative household non-retirement assets that exceed 50,000. And we also have a list of income sources that are excluded from annual income, which are lump sum or sporadic payments, Section 8 housing vouchers, student loans, SNAP benefits, and unreimbursed employee expenses. This is what the attachment 9A looks like. If you aren't using it, you can find it under the Loan Origination tab on the Link Training and Resource Library page labeled Income and Documentation Matrix. You can also find it in Chapter 9 of our handbook. This is another one we recommend bookmarking for easy access. This document is extremely useful for figuring out what to gather and/or assess for the different types of income. For those not familiar with this document, it provides a list of income types in alphabetical order and gives you the required history for each income type. It also provides a list of document source options that are acceptable or required for each income type. And just a reminder that all income needs to be documented and cannot be more than 120 days old at the time of closing. You must review the asset information provided by the applicants and household members at the time of loan application. When the total net non-retirement family assets exceed $50,000, you will need to calculate the income from those assets and include them in the annual income. Net family assets with actual earnings will use the stated rate of interest to calculate the annual income. And family net assets that do not earn interest will use a current passbook savings rate to calculate the annual income. A current passbook savings rate can be verified through the lender's personal banking rates, online website, or other applicable sources. For clarification, net assets means assets that will still be available post-closing. So for example, if a household currently has $60,000 in non-retirement assets, and they will be paying closing costs of $15,000. That leaves net assets of $45,000, which is less than the $50,000 and would not require further calculation for income purposes. In this example, the household has a total of $52,000 of non-retirement assets which exceeds the $50,000 threshold, so an income calculation must be performed. We have a checking account of $17,000, a savings account of $25,000, certificate of deposit of $15,000, so our total assets is $57,000, less the $5,000 from the checking that will be used to purchase a home, and our remaining assets is $52,000, which is over that threshold, and therefore an income calculation is required. Using the same information from the previous slide, the checking account is non-interest bearing and will have $12,000 remaining after the $5,000 closing costs are deducted. We find that the passbook savings rate for the checking is 0.25%. This results in $30 of interest. The savings account is also earning 0.25% interest, which equals $62.50 of interest. Then we have the CD, which at 3% will earn $450. Adding these will give us $542.50 of interest that must be included in the annual income calculation. So this is how you calculate the income from assets. The calculation must be displayed on the Form 355521. And it is not necessary to upload it to GUS for GUS Accept loans. However, the income calculation worksheet must always be kept in the lender's permanent loan file. You will need to upload it for GUS Accept full documentation, GUS Refer with caution, or for files that are not supported by GUS, or also known as manual underwrite. Okay, now that we've gone over on how and what to calculate for annual income, let's look at an example using the Jolly family. Whose income can we count? So we have a total of 5 adults in the household and 6 minors. We count the income for our applicant, Bob, who has a salary of $60,000 a year. Jane, our co-applicant, works part-time and earns $18,000 a year. Grandpa and Grandma receive Social Security income, and Jenny, who is a full-time college student, is also working. The total household income would be the gross amount of all of the adult members, with using only 480 of Jenny's income. We're not counting the full income for Jenny because she is a full-time student, nor any of Sam's income since he is a minor. When we add all the adults' income, we get a household income of $116,880 a year. This is the amount we'll be using as our annual income. Now let's go into the adjusted annual income. Reference to this income is in chapter 9.5. Our agency allows deductions from the annual household income, which will then determine the adjusted annual income. Pages 23 and 24 of the attachment 9A provides a detailed breakdown of the deductions. These include 480 deduction per eligible dependent, childcare expenses, disability expenses, elderly deduction, which is one per household and must be 62 years or older. This amount increased from 400 to 525 last August. And of course, we have medical expenses for elderly and disabled applicants only. Deductions are very important when it comes to qualifying your applicants. If the income limits website determines that they are over the income limit, any of these deductions could reduce their household income enough to qualify for the program. So please make sure you look for all possible deductions. Remember, using deductions is not required. So if your household is clearly, if it clearly falls below the income limits, you don't need to apply them. In that scenario, your annual and adjusted annual income will be the same amount. If you do choose to apply any of the deductions, then it must be documented and the adjusted annual income must be calculated accordingly. And just a reminder that child support and private school tuition are not authorized deductions. Let's review a scenario. Once you have determined your annual income, you can move on to apply all the deductions that are relevant to your borrower to determine the adjusted annual income. Let's take a working family that requires childcare to be able to work as an example. The income limit for their area is $112,450. The gross annual income for the family is $115,800. They're clearly over the income limit. They don't qualify. So let's look for possible deductions. The loan application indicates they have 4 minors at $480 each. This gives them a deduction of $1,920. That brings their income down to $113,880, which still makes them over income. But after further review, we find that they have childcare expenses of $400 a month for 12 months. This allows them a deduction of $4,800. That brings their adjusted annual income to $109,080. They are now eligible for the program. So applying these deductions helped us determine the family's adjusted annual income. And again, this is the figure that establishes the applicant's program eligibility. Eligible disability expense deductions are intended to enable a family member or disabled household member to work or go to school. The expenses must be non-reimbursed by insurance or other sources and must not exceed the income earned by the person who is working due to the care provided. This is an example of how to determine the allowable disability expense. You take 3% of their household income and deduct that amount from the disability expense to get the allowable deduction. In this case, the allowable amount is for the disability deduction is $6,460. Medical expense deductions are permitted exclusively to elderly and disabled applicants only. This deduction does not extend to any other member of the household. And the same calculation applies here for medical expenses. The amount allowed for this deduction is $2,050. Up next is repayment income. This income can be reviewed in Chapter 9.7. Repayment income is used to determine if the applicants have sufficient income to repay the mortgage in addition to any recurring debts. It's important to remember that repayment income calculations are often different from the calculation of annual and adjusted annual income. This is because we only use the stable dependable income for those who will be parties to the note. We are not counting the income of all adult household members, only those signing the note. And stable and dependable income means that it is likely to continue for at least 3 years into the mortgage. And cosigners are not permitted. Again, all income sources must be documented. You must provide evidence to support a historical receipt of earnings. Any gaps in income must be analyzed to determine if the income is stable and dependable. And you should also watch for income with sharp increases or decreases in earnings of 20% or greater. When we look at repayment income, we need to look at the required history. Some basic guidance for repayment income eligibility is 6 months for court-ordered child support and alimony. Voluntary child support and alimony require a 1-year history of receipt. A 1-year history is required for base wages, bonus, commission, overtime, and so on. A 2-year history is required for most self-employment, unemployment, and seasonal employment. Border income, non-occupant borrower, or any income with less than 3 years remaining. For example, child support for a 16-year-old when it is set to end at age 18 is ineligible income. Some income do not require historical receipt, such as VA benefits, Social Security income, and Section 8 vouchers. This income must be received at the time of submission to the agency. And just a reminder, as I pointed out earlier, the attachment 9A clearly notes the required history for the different types of income sources. This snippet from the attachment 9A draws attention to the repayment income section, explaining the repayment income in detail for this specific income type. And it provides the required history and indicates what documents are acceptable to support the income. Any income that is tax exempt may be grossed up by 25% for repayment income only. It is not allowed to be grossed up for annual income. And you can remove any losses from a business that has closed as long as you can provide the necessary documentation. Okay, that was our review of the annual, adjusted annual, and repayment income. We can't emphasize enough that the income needs to be documented. Pictured is an example illustrating how to present calculations or show me the math. It is essential to clearly outline how you calculated the income. While you are free to utilize any form you prefer, we strongly encourage using the attachment 9B as it offers a detailed breakdown of the household income. Each line item assists in tracking the income of all adult household members. Once you've reviewed the income documents you have on hand, you will proceed to fill out the income calculation worksheet of your choice. After completing the worksheet, you will use it to input the figures into GUS. It is important to ensure that the amounts in the income calculation worksheet, the income documents, and the figures in GUS are consistent with each other. The first page of this form breaks down the calculation for the annual income. The second page reflects the adjusted annual income with the deductions, and the last page entails the repayment income. An excellent example of a case study is found in the attachment 9C, which is the form shown on the screen. In this example, we have a husband and a wife, a grandmother, and 3 children. There is a variety of income sources represented here, so I encourage you to review it for exercise. You can find it in Chapter 9. Let's continue with the income verification requirements. This information is available in Chapter 9.3, Section E. Vendors are required to verify the income of all adult household members, except for eligible full-time students, using one of the following documentation methods. We have the streamlined documentation and the full documentation. For streamlined requirements, you will need 1 recent pay stub with year-to-date figures, a written VOE, and a verbal VOE with 10 business days of closing. For a full documentation, you will need current pay stubs covering 4 weeks of earnings, latest 2 years of W-2 forms, and a verbal VOE within 10 business days of closing. These are just a few examples of what you can provide, but remember that attachment 9A also gives you a list of other acceptable documents. For self-employment verification, you will need to submit a signed individual and business tax return for the last 2 years with all schedules plus a recent profit and loss, or IRS transcripts with all schedules plus a recent profit and loss. The profit and loss is not required to be audited. You will need to complete a trend analysis for the applicant's business and confirm that the business is operational within 30 days of loan closing. IRS transcripts are required for all adult household members unless they are a full-time student. The transcripts serve as a quality control tool to verify that all income and asset earnings reported to the IRS have been fully disclosed to you as the lender. The transcripts must be obtained prior to loan closing and retained in the permanent case file. If you're unable to obtain the IRS transcripts, you may document the correspondence to and from IRS in the permanent case file, and this will satisfy the requirement. Any income or asset sources that were not disclosed and are revealed through the transcripts will need further review by the lender, and it could make the loan file ineligible. Another useful resource for lenders is the attachment 15A. It provides the verification requirements and outlines the necessary income documents that must be submitted for every type of loan. We encourage you to follow this checklist when preparing your GUS submissions. Using this checklist ensures that all required documents are in order, making the process smoother and more efficient, which will help streamline the loan approval process and avoid any potential delays. This checklist consists of 3 pages. The first page lays out the requirements for GUS accept files, which requires minimum documents. The second page, which is displayed on the screen, pertains to files not supported by GUS, refer with caution, and files with accept with full documentation. While the final page is intended for streamlined assist refinance submissions. This checklist is available in the USDA link training and resource library page under loan origination. To find it, scroll down to the section titled Documents and Resources or scan the QR code. Okay, that concluded the verification requirements. The next topic we'll be discussing is assets. Assets are covered in chapters 9 and 5. All assets must always be verified and documented. However, you may underwrite in a conservative manner and not consider the assets in GUS. If you are entering assets in GUS and using them as reserves, then you must ensure that the funds will be available after closing. Unverified funds cannot be considered a valid source of funds. This is another example of how you can use the attachment 9A. Pages 25 through 30 offers a list of possible types of assets and indicates at the bottom whether they qualify for reserves and or funds to close. In this example, cash on hand represents the type of asset. The attachment shows that cash on hand qualifies for funds to close, but it does not qualify for reserves. So if you're unsure about whether an asset can be used as reserves or funds to close, you can refer to this document. Regarding bank statements, you must collect and review either the 2 most recent bank statements or a verification of deposit in addition to a current bank statement. If you are going to use these funds, you will use the ending balance from the most current bank statement or the VOD, provided that the VOD is dated after the bank statement. The reserves that you entered in GUS must not exceed the balance on the most current official monthly bank statement. And again, you may be conservative and choose to use a lower balance or no amount at all. That would be at the lender's discretion. I do want to point out that we accept official electronic printouts of monthly bank statements. Let's take a moment to clarify 2 important financial concepts in the Guaranteed Loan Program: funds to close and cash reserves. They may sound similar, but they serve very different purposes in the loan process. Funds to close are the total dollars a borrower needs to bring to the table at closing for items such as closing costs, prepaid items like taxes and insurance, and any down payment or required repairs. Cash reserves, on the other hand, are what's left in the borrower's account after closing, essentially their financial cushion. Funds to close can be sourced from the borrower's own funds, gifts, grants, or seller contributions. Cash reserves, however, must be liquid and verifiable. Think checking or savings account. Retirement accounts don't count unless they're fully accessible. 60% of the vested amount available to the applicants may be used as reserves. Funds borrowed against these accounts are not eligible for reserves. Funds to close are always required. They ensure the borrower can complete the transaction, while cash reserves are not required, but they can strengthen a loan file, especially if in marginal cases or when compensating factors are needed. And both concepts are clearly defined in USDA guidance. Funds to close are covered in chapters 6, 8, and 9, while cash reserves are detailed in chapters 5 and 9. That concluded our review on assets, but before we end, let's look at some tools and resources that you can use to make navigating our program even easier. The main place to find resources for origination and servicing, along with guides, is the USDA Link Training and Resource Library page. The Link homepage has been updated to show the turn times for conditional commitments. This site is full of information, so we recommend you save it as a bookmark for easy access since you'll be visiting it often. Also, if you've missed any important updates from GovDelivery, you can easily check out an archive of previous emails on the site. If you haven't done so yet, make sure to sign up for GovDelivery notifications to keep yourself updated on important policy changes or upcoming live trainings. A web link or QR code is provided to quickly save the link library page. Our technical handbook, known as a Handbook 1-3555, is intended to improve the understanding of the regulations while providing additional insights. It contains 19 extensive chapters, specifically created to complement the 7 CFR. I want to take a moment and highlight for anyone who is not aware yet that our handbook has been consolidated. It is now available as a single document. And don't forget to bookmark these resources, and as with any document, we encourage you to use the Control F to navigate quickly. Our policy team has put together a helpful resource as an FAQ document. This document answers important questions from lenders who want to better understand how regulations and handbook practices relate to particular situations. It provides a variety of examples and some interesting scenarios, so we encourage you to look through this document. It's updated periodically, so make sure to check back for updates. If you still have questions after exhausting your tools and resources, we are always here to support you, so please feel free to reach out. You can contact the Guarantee Support Team by sending your questions to the specific team's email address. Just click on the link or scan the QR code and you'll be provided with a list of our departments. You can also reach us at our toll-free number listed here between the hours of 9 a.m. to 3:30 p.m. Eastern Time. To get a quicker response, choose the option that relates to your question. And if you're having technical issues with Gus, here's the number to call. This wraps up today's training. We appreciate you taking the time from your busy schedules to join us. We trust that you found the training beneficial and that it offered you valuable insights and skills to implement in your work. Your partnership is important to us, and we look forward to continue doing business with you. Thank you and enjoy the rest of your day.